Welcome to the Future of Ground Transportation podcast, where we discuss the exciting innovations that lie ahead for organizational ground transportation. Each episode, we cover topics tailored to those resolving transportation-related challenges and provide tips, tools, and trends that will inspire you to stay ahead of the curve. And now, here's your host, Daniel Perez.
Hello. Welcome to the Future of Ground Transportation. Today we have a special guest, Mr. Kenneth Lucci. Kenneth Lucci is the principal analyst at Drive-In Transactions. Drive-In Transactions is a mergers and acquisitions specialist in the ground transportation industry. Mr. Kent, thank you for joining the podcast today. No, thank you. It's a
Thanks
pleasure
for having
having
me,
you with
Daniel.
us tonight. How's your night going
Thank
so
you.
far?
Good, busy. I mean, the M&A space is always busy. The valuations that we do are always busy, and we also work with 3 different lenders analyzing financial statements before they make lending decisions.
Awesome. So before we get
much
started,
busier than I thought
Ken,
we'd
tell
ever
us a
be.
little bit about your background and how did you get started in the ground transportation sector?
Wow, that's going back 1,000 years. So I was in the medical alarm business. You know, I've fallen and I
Okay.
can't get up, those little buttons, in Florida, in the state of Florida. And I sold it in 2005. And prior to selling that company, I was also a consultant for the New York Yankees in the Steinbrenner family, doing security and risk basically for the family. So when I sold my medical alarm company, Mr. Steinbrenner basically said, I told him I was going to retire. And he said, you can't retire. And very long story short, he talked me into getting into the limousine industry because in Tampa Bay, there were no, in his mind, quality New York top shelf 5-star level chauffeur transportation companies. So started working with them during spring training of 06. They convinced me, or he convinced me, and I worked directly with his son to expand and to go into business myself. We founded the company in July of 2007. We were able to post $1 million worth of business in 1 year, in our first year, through differentiation.
Yep.
I had a consultant named Tom Mazza, who was very well known in the industry. He also helped me buy 2 companies. I bought 2 companies, one in 09 and one in 10, and we were able to get the business from 7 to 12.
Awesome.
In 2012, we hit 5 million in sales, and then I decided to sell it. I kind of reached my Peter principle with it. Had a lot of fun with it. At that $5 million level, I was facing, to me, a reality of either double down financially on the business and keep it growing, or
Totally.
it just happened to be a great opportunity to sell at the time. So we ended up selling it. I got my last check out of it 2015.
Awesome. And as you
And
reflect
I've been
back,
consulting
Ken,
ever since.
going
Really.
back, and as you reflect back today, do you still believe that you make the right decision, or would you keep correct?
On selling the business, I've built and sold 4 businesses, and I've never looked back at any one of them. The first business I had was when I started the company when I was 17, sold it when I was 25 years old in the security space. In East Boston, Massachusetts, I sold it to a company named Sentry. And then the second company I owned was the medical alarm company. Bought that from Bell South in 2000, sold it in 2005 for $8.5 million, and never gave it another thought. And then started a security company and a small patrol company and sold that. And then the limousine business. I think it's a flaw in my personality that I like to build and grow things. And from an entrepreneurial perspective, I think it was I get them to a certain point, and I just decide, you know what, maybe I've had enough. And coincidentally, most of the time when I've had enough, a good opportunity to sell comes up. We sold the medical alarm company to an oxygen firm from California. I wasn't looking to sell it. Just so happens that the private equity firm that I was involved with said, hey, look, these guys want to come see you. The oxygen company decided, this was 2005, they decided they wanted to get into the medical alarm space. And then the limousine business, I sold it because a fairly good friend of mine in the industry had the contract with Hard Rock Casinos. And I just finished the presidential conventions in 2012. We did both the Republicans in Tampa and the Democrats in Charlotte. And he just caught me on the right day. He asked me if he could borrow some equipment for the weekend. And I said, I have a better idea. I said, why don't you buy the company? He said, I don't have the money to buy the company. And I said, can you scrape together X amount of dollars? He said, yep. I said, all right, here's the structure. We agreed to it. It was a very honorable guy. I actually refinanced it a couple of times. But I don't typically look back. There's probably a flaw in my character, but I get it to a certain level, and then my mind starts to go into other directions. So, no, never.
Awesome, great.
Can't have regret in life, Daniel.
So, fast forward now. Tell us about your role at driving transactions. What is it that you do, and sort of what solutions are you driving in the industry?
Sure. So after I sold my company, I wrote a book called Driving Your Income. It was about maximizing your income as a chauffeur. We sold about 15,000 copies. It's out of print. And I was going to do chauffeur training, but I started consulting for a lot of my friends in the industry. Bobby Bellagamba owned a company called Concord Worldwide in New Jersey. Bobby was like a $18 million operator. So in 2017, he and I started working together, just general consulting. And all of the guys like that in the space at that time wanted my help, financial assistance or review of financials, or they wanted help buying companies or selling companies. So I got certified on Sage valuation software. I didn't step out into in the consulting space to do this, but I got certified by Sage to do valuations, and then we got certified to do fleet valuations. This is like the 17, 18 timeframe. So we started selling companies in 18, preparing them for sale and doing valuations. Sold a couple of companies in 18, sold a couple of companies in 19. Pandemic hits, and we start getting phone calls from lenders. I was referred to one large commercial bank who had laid off all of their financial analysts. And they said, look, we've got all these fleets out there. We need somebody to do financial analysis. So my business partner he's a genius. He's a young guy, 30 years old, and he has a degree in corporate finance from Penn State. So I know the business side. This kid can make love to an Excel workbook. He can make an Excel workbook sing. Okay, he can figure out any financial ratios. So very long story short, during the pandemic, we started getting heavy into M&A activity, but also heavy with workout situations with the banks. The banks kept working with us after the pandemic. And in addition to that, the M&A activity picked up. So we do valuations based on a review of 5 years financials, and we do an evaluation on your fleet. And we might have to do that for bank covenants, estate planning, partner buyouts, divorces, and then the M&A world when you want to sell your company. So my job really has been, from an industry perspective, is I go out and get the work. I come in and I'll do the setup analysis. Cole Weber, my partner, and I will go through, we'll do a full financial analysis. I write all the valuation reports. Researchers do the fleet reports. So to date, we've reviewed 230 sets of financials from 230 different companies. Multiply that times 5 years each, okay? We've sold 24 companies. We've done about 80 valuation reports for everything. I mean, a guy wants to buy life insurance. Yeah. His life insurance company wants a valuation on the business. Keyman Life Insurance wants to buy out his partner. You know, divorce is a big thing. So we learned a lot of financial metrics about the industry from this process. And I didn't get into consulting to say, you know what, I'm going to specialize in financial review and analysis. It just happened that way. And, what we do more than anything is we position companies and condition companies to buy, sell, or borrow. My goal with people who want to grow, I want you to have the ability to borrow from a traditional bank. Now, some of my clients are leasing companies and commercial lenders, that may lend above interest, above prime interest rates, but I also do business with commercial banks. I want every company I deal with to be bankable, because if you call me and say, there's a motor coach company that's got 20 vehicles and I want to buy it. Okay, I want you standing on your own. I want you to have a good foundation. And what we found that I was really shocked by, 80% of the financial statements that we get from whether banks or sellers are not formatted for our industry. They're formatted for the purpose of financial accounting, not financial analysis.
When you said for financial analysis with their CPAs, but sure, not, because I always tell my team there's a way to manage the business with your financials, and there's another financial statements that you just submit to your CPA, and there's another financials to create business valuation and maximize your value.
Sure, absolutely. Financial accounting, when you hire a business accountant or your bookkeeper, their primary responsibility is to create financial statements for the purposes of creating tax returns. Our job is to format the financials for the purposes of an analysis. For example, when I get financial statements, there's income at the top and there's a whole chart of accounts of expenses. 80% of the time, cost of goods is not calculated. It's not there. The chart is not set up properly for cost of goods. Now, in our industry, labor is 30% of the income that we have, and your fleet expense and your repairs, maintenance, fuel, et cetera. First thing we do is set it up in a strict cost of goods model. That gives you your direct cost of goods and your gross profit, blended gross profit margin. Then we'll go in and we'll look at your G&A and we'll separate out all your ordering and logistics expenses, meaning reservations and dispatch. Why? Because I want you to use technology to lower those expenses. I want you to find every possible way to not have high reservations and dispatching expenses. Now, a little boring, but I can tell you that dispatching and reservations takes up between, on the low side, 6% of total income, on average, 8% of total income, right? The highest I've ever seen it is 11% of total income. Now,
got it.
Reservations and dispatching together most of what I look at is 6 to 8% of revenue. That means $6 to $8 out of every 100 goes to ordering and logistics. Now, we also do a lot of KPI analysis, and part of the financial analysis we do is to say, okay, so you did 1,000 reservations this month, and you spent $10,000, $12,000, $20,000 doing it. Okay, just do that math. You could be spending $8, $10, $12 a reservation to do processing, labor. So if you can use technology, okay, and or non-specialized labor, that goes right to the bottom line. So my point is that when we get raw financial statements from banks and sellers, it's always formatted to do tax returns. You can't get any analysis out of them. So we order the chart of accounts specifically for this industry. And one of the big pet peeves I have with every CPA we talk to, and they always come over to my side, is they will throw fleet depreciation below net ordinary income. Well, what does that mean? That means that they're not accounting for your fleet expense in your ordinary operation. And they're letting you think that you have 40% cost of goods or 50% cost of goods when you actually have more like 70%. They're letting you think you made 50% gross margins or made 15 to 18% net ordinary income because they threw you depreciation down below the net ordinary income line. Well, that's great if you're depreciating a copy machine or office furniture. But in our case, we are depreciating the primary asset used to generate revenue. It's got to be somewhere in cost of goods. So we do all this analysis, and people say, geez, that's pretty detailed. The only thing that sells companies is financial data. The only way a banker will lend you money is if you have on your financial statements the ratios we create. Let me give you a good one. And I learned this from the banks. Your balance sheet, by the way, the most neglected financial statement that there is, okay? You have profit and loss statements, cash flow statements in your balance sheet. A bank wants to see your long-term liabilities no greater
repeat
than
that
30%
again. And again,
of your
for all the
annual
listeners,
income.
we're going very deep into this terminology. Well, totally get.
Probably too deep, but that's okay.
Yep.
You tell me if I'm going
good.
too deep, because I live this shit every day. And sorry. So what that means is your balance sheet shows all of your liquid assets, your vehicle assets, then your liabilities and your long-term liabilities. One of the statistics that banks want to see is they want to see your long-term liabilities add up to less than 30% of your annual income. Okay, that's one of the balance sheet ratios they look at. So if you do $10 million, your long-term liabilities should not exceed $3 million, and the long-term liabilities should all be associated with fleet vehicles. Example: you've got EIDL loan of $1 million. Well, that's a 30-year loan that technically is not tied directly to a fleet asset. So a bank will look at that, and that's something that just came up this year. When we're dealing with the banks, they're saying, Ken, what's his long-term liabilities look like that's not associated with fleet assets? So when we do a full financial analysis, we do just only one page. A bank wants to see one page from us. But when we do an analysis for the purposes of valuing a company, or an analysis for an operator who wants to be bankable, our analysis is 10 pages long. It takes you from tax returns, balance sheet, cost of goods formatted P&L, and then all your revenue KPI reports. And they've drastically changed since post-pandemic. I can tell you, this industry as a whole is tremendously more healthy.
So tell us a little bit about that, Ken. And so two questions.
And
after looking at all this data and all these financial metrics,
sure.
What is the KPIs that stand out to you the most? And because for me as an entrepreneur, and especially when I coach other mentees or other entrepreneurs, I always tell them, look, we want to be able to identify the businesses that are the winners from the losers. And if you cannot understand, and if you cannot read the scorecard,
no question about
you cannot identify the winners from the losers, right? So with your experience, Ken, what are the key KPIs that banks? So you mentioned the sort of the long-term lab. Yep, that's. What are the other ones? Whether it's EBITDA,
yes.
or do you guys go into free cash flow as well? Like, what is the other sort of?
Sure. So first and foremost, first thing we do is the shocking thing that I came across when I started doing this is that most businesses don't keep monthly financials, and if they do, they don't look at them for anything specific. The first thing that banks look at is your gross profitability. Okay, so it's very simple. Take all of your direct cost of goods, everything it takes you to turn the key and to provide the service, your fixed expenses being the fleet, fixed expense being your insurance, and then all of your variable expenses. Okay, and your direct labor. You take all of that, ideally, you want that to be 55% to 60% of your total income, no more. I like to see it 50 to 55%. Now, when your fleets are diverse, and you have a large percentage, like half of them are large equipment, maybe 2/3 are large equipment. The larger your equipment, believe it or not, in this day and age, the better your cost of goods becomes because your hourlies are higher, right? So I'd like to see, the first stat is very simple. We've calculated direct cost of goods. That leaves us with gross profit margin. The first thing that I say to Cole is, when we reformat, is what does their gross profit margin look like? And a banker made it very simple to me. I said to him, why are you obsessed with this? And he said, simple. I can tell this guy to lay off his administrative assistant, but I can't tell him not to pay his fuel bill. So we take the statistics on every single direct cost of goods, and we're able to match it with industry averages. But the total pack category of direct cost of goods, you want to be between 55 and 60%, because that leaves you with a 40 to 45% gross
limousine
margin.
operators or for motor coach companies too?
Oh, diversified fleets, diversified across the board. Motor coach operators, and we've looked at some seriously large ones, can get, some of them can get cost of goods down to 50%. Okay, it all depends on how they buy their fleet, because don't forget, we usually put straight line depreciation up in cost of goods, or we put your loans in cost of goods. So I'm seeing, to answer your question, I'm seeing margins on motor coaches now of greater than 45 to 50% gross margin, whereas pre-pandemic, those businesses were lucky to be at 30 to 35% gross margin. Gross margin, because think about it this way, Daniel. If you take 100% of your income, and you have 50 to 55% or 55 to 60% cost of goods, that only leaves you 40 to 45 cents out of every dollar to pay all of your overhead and to show a net ordinary income of above 10%. That's the next thing the bank wants to see. The bank wants to see your net ordinary income ideally above 8 to 10%. Now, they know that, hopefully your owner income is in G&A, et cetera, but they want to see a net profit. Banks don't like to look at constant net losses. They just don't. Because they look at there's some sort of a flaw. And prior to the pandemic, I'm going to tell you what the flaw was. We were artificially too low priced on our hourly rates because the industry in general, good, bad, or different, small, medium, or large, they sold their services based on price and not based on knowing their cost. And I'm the only guy in this business that can say that vehemently, because I've looked at 230 sets of financial statements. Now, when banks send them to me, in many cases, they have no names on them. But between what the bank sends me, right, and everybody I know, and the valuations we've done, and the sellers and buyers we speak to, nobody's got the data that we do. So the banks want to see that ratio. They want to see those numbers. They want to see 55 to 60% direct cost of goods, leaving you with 40 to 45% gross profit margin on services. And I say that blended, right? Then the smart ones say to me, why is his overhead 35% of cost of goods? I mean, of total income. And I say, well, because, his wife is on the payroll and he, his cars are in there. Don't worry about it. The business is doing well. When I back him out, the business is very profitable. So the banks know that private businesses do this, and it's up to me to break out owner consideration. The most important thing a bank wants to see is that when they look at your balance sheet, there's no question that they don't want any long-term liability. First of all, your current assets, meaning your AR, your accounts receivable, and your cash, should cancel out your current liabilities. They want to see your long-term liabilities no greater than 30% of your annual income. And they want to look back at that to see, because that, when you look at that, that gives them comfort that because we're in the hard asset business and these assets are going to last 4 to 5 years, that you're going to be able to pay them off and you're going to be able to generate enough cash to pay them. Now, then from a standpoint of free cash flow, you definitely like to see free cash flow above 15% of net ordinary income. Now, there's several ways to get to free cash flow. EBITDA is very important because it takes your total income, adds back your depreciation, adds back taxes, adds back interest. People don't realize there are two types of depreciation. There's balance sheet depreciation, and there's depreciation expense. Balance sheet depreciation is either done on a tax basis where you're taking as much depreciation as you possibly can, or it's straight line depreciation, which is more closer to what your true fleet expense is. But the depreciation expense on your P&L, it really, in what we try to do is we put it up in the cost of goods sold to account for your fleet expense. So if Daniel goes out and Daniel spends $500,000 in cash on a motor coach, where does Daniel account for that on his P&L if he has no loan? The answer is his depreciation schedule. Okay,
Right.
because he's allowed to depreciate and write off a percentage of that every single year. So we put it in cost of goods more as a test than anything else, because a lot of operators will say to me, well, I'm making 55% gross margin. I'm like, really? Where are you accounting for your fleet? Because even if you pay cash for it,
Correct.
you're going to depreciate it. You still have to
And
get
Ken,
an
is
internal
it fair
rate
to
of
say
return
to
on that
get
piece
to
of
the free
equipment.
cash flow too?
So
Take the EBITDA and subtract the depreciation.
your depreciation, you take your net ordinary income and
Say that
you
again.
add depreciation, then that gives you close to a cash basis. You take your net income and your depreciation expense, and that gets you close to a cash basis. Because keep in mind, that depreciation expense from the P&L
Right. So,
is
yeah,
not a check that
it's
you
a
write.
it's a credit
It
pretty much.
is right. Depreciation, exactly. So that gets you close because a lot of businesses don't keep monthly cash flow statements. So there's several cash flow equations that we can create. And part of this is talking to your CPA and saying, did you use what I call tax depreciation, which is literally double the amount of depreciation? It's not straight line. It's the maximum allowed. Or did you use true straight line depreciation? And straight line depreciation, the easiest way to think about it is it's the amount each year that you're allowed to deduct based on the
Ken,
useful
thank
life
you
of
for
that
breaking
piece
that
of
down for
equipment,
us.
right?
Switching a little bit of the subject. So every time that you get an approach by either a buyer or seller, help us understand sort of the mindset of the ground transportation operators. Because I know when we spoke that last week, a lot of times when we're looking to acquire other competitors in the space, a lot of folks have sort of a mindset that their business is worth 1,000 times more than what it really is.
Oh, please, trust me when I tell you, it's the second biggest revelation. The first biggest revelation is really the lack of financial sophistication that I see, and the lack of financial management. Because most people literally, their relationship with their accountant is once or twice a year just to do their taxes, not manage the business by the financials. So that was revelation number one. Revelation number two was people thinking that even though they didn't make a lot of money every year, there was a pot of gold at the end of the rainbow. And when I dissuade them of that, I become the bad guy, right? So we literally, we broke our services up into two phases. One is a 5-year analysis and review of your business and your KPIs, where we establish a valuation range. And there are only 3 ways to value a business. One is an asset method, which
Yep.
is the value of the hard assets, okay, which is only really used in the wedding industry or the specialty industry. The second is the income method and the market method. The income method is a multiple of EBITDA. and we have our own internal matrix on the values that we come up with. The second is market method, and it's simple. Based on the transactions that have taken in the industry, taken place, what is the market bearing? What are buyers paying? And if I'm not involved in a deal, I'll pick up the phone and I'll call the buyer or the seller and I'll say, just give me some ballpark. It went for this. So we use the income method and the market method. We will occasionally value something with an asset method. Again, if you're talking a very specialized business where the assets are so specialized that the business could not be absorbed without them. So when we do this for people, we break down that phase. If they don't agree with our range and the rationale behind it, we don't proceed. Because it costs us on average about $1,000 a month to advertise these businesses for sale. Not to mention the time it takes to interview all the prospective buyers, separating the dreamers from the people that financially can afford it, right? So the reality is this. When you're selling a certain size business, and let's just say for the sake of argument, it's between $1 million and $3 million, what you are fighting is the buyer's ability or the buyer's thought process that they can create $1 million to $3 million a year in annual revenue cheaper than they could if they bought your company. Then the acquisition price of buying your company. That's the reality of, I would say, 8 out of 10 companies in the industry, because that's where most of them fit, right? Between the 1 and 3 million range.
Acquiring a company for less than you could.
When you have a company let's break it down this way. My company was 5 million, and that got me in the top 8% of the industry. I was shocked. Okay. 80% of these businesses fall in the annual revenue category of between $1 million and $3 million. So the reality of selling that size business is the buyer will have a mindset, is it cheaper for me to hire a salesperson, put a new website up, start from scratch? Is it less risky and less expensive than paying that guy for his business? Okay, that's the reality that you face. And let me back up. The only thing that sells companies is financial metrics. Your brand means nothing. Okay, 99 out of 100 contracts means nothing because they're all cancelable within 30 days. Financial data and metrics is what sells companies. And the reality is that gross margin is incredibly important, because a buyer will say, and I'll say to the buyer, look, this guy's making 45% plus gross margin. So when you fold him into your operation, you're obviously going to have less expenses, so you're going to make more money. And I sell to outside the industry people. I'm able to sell when the net ordinary income is good on a lifestyle business. I'm able to say to the person who just retired from corporate America, look, this guy's taking $250,000, $300,000 a year out. This is a good business. This is a good business for you to learn. So it's the financial metrics that sell companies. It's heartbreaking for me. And this is the reason why we broke down what we do into 2 phases. When I analyze a business, somebody says to me, my business does $6 million a year. How much is it worth? I can show you a business that does $6 million a year that's worth three times EBITDA all day long, and I'll have 3 buyers waiting for it. I can show you a business that does $6 million a year that I can have marketed on the market for a year and a half and not have a bite. So the full analysis is really what determines the value, and we charge for it. And if they don't agree with the range, by the way, when we charge the upfront fee, that comes off the back end of the sale. So the key is to address what you said, what you and I talked about. The perception is that there's a pot of gold at the end of the rainbow here. And my advice is very simple. The answer is there is none. Okay? And what you've got to be doing as an entrepreneur, as an operator, is taking money off the table every single year and investing it elsewhere. Okay? The most profitable companies that I've ever sold owned their own real estate. The most profitable companies I ever sold bought a large portion of their equipment paying cash. Oh, by the way, the owners also owned a leasing company, and they paid themselves an internal rate of return of about 8.5%.
Sorry, can you break that down for us?
Those
as far as the leasing company.
Sure. So when somebody's in a good cash position, they're able to lend money back to their business. So Daniel every year takes W-2 income, and he may take distributions. Daniel is now in the position when he wants to go out and buy a $100,000 SUV. He doesn't have to go to GMAC and pay 8%. Daniel personally can lend the company money, and he can get an 8% return on that money. Okay, you know, somebody much smarter than me said, you know, you're making money when you become your own bank. Okay, now to go back to the issue, and look, we're very successful selling companies. It's hard, but we sell 8 out of 10 that we take on. The secret is we don't take on every one that we analyze, because, you know, I can do many things, and we're very good at showing what good opportunities are to buyers. But the reality is, Daniel, we are, for the most part, in what I call the at-will service industry, okay? And I mean, I don't make up the rules. Perhaps I articulate them better, but I have to live by them. The at-will service business is simple. It means that your clients are under no legal contractual obligation to give you more revenue, to give you future revenue. So the entire basis of this business for sale, it's based on the hope that future revenue keeps coming through the door, okay? So when you tell people that reality, sometimes they're like, well, you know, he doesn't think he could sell my business. You're right. I just don't take on the assignments that I don't think I can sell. Because if you didn't make money and you didn't accumulate wealth along the way, and you didn't pay yourself above market compensation, what makes you think the next guy can?
By the way,
right? That's reality. But listen, but here's the beauty. This industry is finally in the financial metrics, in the strata of charging our clients where we need to be in order to create great profitable companies with great enterprise value. Okay? I just pray that we don't slide back into,
so do you see
how much is he charging you? I'll beat him by 10%.
Getting into the space if we start driving prices up?
So the elusive private equity. So you have to understand that half of my time is researching who to sell companies to. So let me talk to you about private equity. I come from the security background, and the security system background. That industry went through private equity like crazy, and I'll tell you when it happened. It happened when the technology in that industry changed. And 150 years ago, in order to provide monitored security service, you had to have a station in the local area because your telephone lines didn't leave the local area. And then you had cellular phones came into technology, which meant you could monitor from anywhere in the world. That technology change increased the net profitability, lowered the costs, and improved the net profitability of that industry by 20% overnight. So my answer to your question is, private equity is only interested in industries where when you put 1, 2, 3, 4, 5 together, you can improve the net ordinary income by a 2x multiple, okay? Because we are in the hard asset business that also is all associated with labor. Okay, so what's gonna change that? Okay, number one, EV vehicles are going to definitely change the cost metrics of the industry. Okay, because fuel averages 7 to 9% of total income. okay? Repair and maintenance averages between 4 and 6 to 8%. If you have an older fleet, your repairs and maintenance are between 6 and 8% of total income. So what's going to change that is EVs are going to bring the maintenance and repairs down. So EV vehicles are going to change and eventually lower the cost of goods. Now, why? The useful life on them, we don't know yet, but everybody I talk to thinks the useful life is going to be between 30 and 50% more useful life, but they're new. We don't know yet. But we do know repairs and maintenance and fuel are going to be drastically lower. I started to say that the charging costs between 1.8 and 2.5% of total income. That's the analysis we've done. So you take a 9% fuel down to 2.5% charging, right? Now look, we have to pay for infrastructure, the rest of it. Okay, what else is going to change the industry to get private equity interested in us? Okay. The technology has to change where the customer experience and the ordering and logistics aspects of our industry have to be drastically better than they are. Meaning, the entire reason why Uber and Lyft and companies like CharterUp and a few others have attracted private equity money is because they made the customer ordering and payment experience and tracking of the service 10 times easier than we make it. Okay, right. So trust me, I talk to private equity companies all the time and sell the assets, sell the benefits of consolidation. But please understand what consolidation of industries normally happens from outside the industry. Okay, that's number one. That's just an industry statistic. I mean, it's just true. But in our industry, unfortunately, when you take one company and you make them two, no one has shown private equity where 1 plus 1 equals the same revenue or maybe 20% more revenue, but more importantly, 20% less cost. Because typically it's taking 10 reservationists and 10 reservationists, and now you have 20 reservationists, right? There's no economies of scale. Trust me when I tell you. I mean, I've got some of the biggest books of companies that in the industry that could be for sale. And the problem is private equity wants the very bottom line answer. How are you going to guarantee me above 20% growth every year? And how are you going to take your net ordinary income and double it? Because that's what they want. And frankly, they want the buzzwords of technology and advancement. Now, what's going to change this in the future? Frankly, I think autonomous vehicles are going to be a fantastic thing for the industry because I do not believe you're ever going to have a pilotless vehicle, just like you don't have a pilotless train or a pilotless plane. But you're going to not necessarily need to pay that person based on specialized labor rates. I think autonomous vehicles, also certain categories in certain places, are going to happen faster. And I think that because we have the demand, we have the client, we have the institutions that buy our transportation, I think they're going to be a good thing. People have said to me, well, we think the manufacturers are going to get into the autonomous vehicle
that is
business.
a really
I'm like,
good point.
They're not in the rental car business. They've already tried that and failed. It's just not going to happen. It's just not. You know what an auto manufacturer stockholder wants them to do? Just make automobiles. Just get that right. Okay. So I do think that's going to make a difference with PE firms. I also think that somebody's got to make a credible case where I don't care how much money it is together, how many organizations, 5, 7, 10. When you put 10 of them together, when you put this amount of money together, you have to show me where you're going to achieve a greater than 20% growth, and you have to 2x your net ordinary income. I mean, I hate to tell people that private equity is not interested in a 10% net ordinary income. Wait a minute, in a hard asset industry, right, where 30% of the expenses is direct labor, right? So this is why I try to tell people, you better make money along the way. And I have the best use cases with my sellers. Some of my sellers they were liquid millionaires before I sold their companies. They had already done the right thing as far as they built their own real estate and they leased it back to their companies. They bought vehicles, paid cash. They had a leasing company because, as one of them described it to me, when you're in a nickel and dime business, and let's face it, achieving a 10 to 15% net
it's not
ordinary
rocket
income,
science.
this is not high profit margin business. You have to manage every nickel and dime, and the most successful sellers I ever had managed every nickel and dime and was the least amount of work reformatting their financials. And when we sold their companies, they weren't looking for the end of the rainbow gold. You know what they were looking for? An improved life experience. That's what they were looking for. They were happy with the multiples we sold the companies for. Don't get me wrong. And some of them were very happy. We did some very fantastic sales, great annuity sales, great structured sales. Some people stayed on, some people retired, but they were looking for a better life experience. That's why they were happy for me to sell it for them. So when I talk to people about selling their businesses, the first thing I tell them is the statistics on selling private businesses, and I don't have them all off the top of my head, but I can tell you that less than 30% of companies that do $10 million or below sell to second owners. Okay, the statistics are pretty shocking. When you hire a general business broker, you have basically less than a 1 in 3 chance of selling your business. When we take you on as a client, you have basically an 80% chance of selling. Okay, now if you're ready and you're realistic, and the realistic is the value range and the structure that we agree to. I mean, I've had some tough conversations with clients that said, you know what, I'm not the guy for you. I think you ought to go with a local broker and do your best. But I'm telling you, I can't get you what you think your business is worth.
Totally. And Ken, if I may, especially let's switch a little bit of the subjects so that way we could give a little bit of a context too for individuals that might be considered selling in the next 12 months or 18 months and vice versa. So what is sort of your state of mind with the economy? Because obviously I'm a huge believer that you could be doing the right thing on the wrong time, or you could be doing the wrong things at the right time. So when I speak with a lot of operators, there's a lot of uncertainty in the market, and I'm curious to get your perspective. I'm also curious if we were to, where do you see sort of the market and valuations in the next 12 months and 24 months?
Well, listen, I think that the CVB and the Signature Bank thing did not help the perception that the economy is heading into a bad time. I can tell you from dealing with buyers with some very large companies I have for sale, they're concerned. Now, having said that, my personal observations of the industry and our research is that during the pandemic, we lost a total of 50% of the operators in the industry. Okay? Now, it's certainly statistically accurate that we lost 50% of the motor coach operators. You can go to the FM CSA website, okay, the DOT website, and it'll show you who's closed and who's open. But our research is, from a chauffeur perspective, we lost 50% of the operators. We lost 1/3 within 120 days of the start of the pandemic because they did not have the liquid capital to survive to PPP or EIDL. Then we lost another 20% of the operators based on not being able to make it to the hard recovery, okay? Because their operations were decimated. So with 50% less capacity and the demand the way it is in the industry right now, we can take a 20% hit to top line income and still run profitable companies. So I believe, and this is, look, I'm on the Economist's website every morning. I do the things that operators can't do. I sit and read because you guys are busy running your businesses. But I still think like an operator. Unless there's something catastrophic that can macroeconomically to shut down the industry again, like a 9/11, like a financial crisis, like the pandemic, I think we're going to be fine. Now, it will slow down M&A activity. It will not slow down the valuations, and it will not slow down people thinking of selling. It might slow down transactions a little bit because we deal with the SBA and we deal with, obviously structured sales. But at the end of the day, Daniel, it's the perception that we have an economic problem more than the reality, because I think you'd agree that you'd love to walk into a business that had 50% less capacity than it did 5 years ago. Okay, 50% of the competitors, right? So we could take a certain hit. We could sustain a hit. But here's the key. You got to keep your debt low, and you've got to make sure your pricing integrity is there, and that you're making heavy gross margins on your business, on your trips. Now, I was allowed 5 minutes at the state of the industry to give what amounted to 20 minutes of information, but I only touched the surface on the realities of where we are as an industry. This industry is in better financial condition than certainly any time I was in it. Okay, and the primary reason is because everybody from a reactionary perspective went way up on their pricing. Okay, they didn't do it based on knowing their cost. They did it based on, it was more a defensive thing because they had so much business coming through the door, and they had to attract their drivers to come back. But the reality is that this is a critical time in the industry to know your cost and manage your cost, okay? Because commercial insurance is going up by 20.8% this year over last. You have the Florida hurricanes that are drastically going to change the commercial policies. And I'm sorry, but it's an ecosystem of insurance, okay? So your loss runs are only a piece of it, okay?
Yep.
So my point is your cost structures are commodities that can change on the dime. So when you say to me, M&A activity, what is it going to be like 12 to 18 months? I think the perception is that buyers are they're going to only want to take on transactions where the risk to the buyer is calculated and known going in.
Totally. Very well said.
Okay.
So no, very well said, Ken. Thank you very much. So to wrap up the episode, we normally went longer than normal, but you dropped so many nuggets. So for all the listeners,
well, this is not sexy stuff, but it's not as sexy as putting a $108,000 Escalade in the fleet and talking about it on Facebook. But
totally.
Daniel,
Totally.
I kind of wish that this was a topic when I was an operator. I was a terrific top line operator. There was nobody better at capturing business than me. But
I agree.
But nobody sat on my shoulder and said, "Wait a minute, you're spending $500,000 on a motor coach. You only do $100,000 worth of motor coach farm out. Why are you doing this?"
Yep.
We need to pre-book these things. We need to do an analysis and say, "Okay, Ken, you want to buy it. This is what this thing costs you. This paperweight costs you to sit in the yard every day." When I go through that analysis with my clients, they look at me like, "Ken, those numbers have to be wrong." I'm like, "You just saw me do a financial pro forma." It's true. If you really took into account your costs and managed them, the beauty is you're never going to sell on price again. And the second is you get a little selfish. You start saying, you know something? Daniel's taking a lot of risk. He deserves to make money. And that's the end of the day. It's profit is the new growth to me. And profit is progress. Top line revenue is total vanity. Bottom line profit is sanity.
Profit is the new growth.
Profit is the new growth. It is true.
Yep.
It's totally true. I talk to operators every day. For some reason, I'm like Father Confessor for some reason. They want to tell me everything. And they also ask me a lot of questions, which I feel very good about because we sit in a very good position to have very good industry data. And I'm dealing with operators now that are, to me, they're finally getting it. They're saying, I would rather do 20 less trips today and know that at the end of the month, I'm going to be able to have X amount of dollars going into my savings account.
To my distribution account.
Correct. So, that I do think we're going to be heading into some uncertain times. And I follow about 12 to 15 macroeconomic things that go on around the world. Excuse me. Things like what happens if the Russians use battlefield nukes on the battlefield in Ukraine? Jesus, that'll shut down travel in all of Europe, right? So there are about a dozen things that the economists on the Economist website, and by the way, I can only understand every third word because these guys are unbelievably intelligent.
Yeah.
There are macroeconomic things that you and I can't predict. But from a micro perspective, the only thing that could hold us back as an industry is, number one, is getting back to low prices, or number two, getting too much debt. Because we can take a hit as far as demand, because demand is still way up there, because capacity comes back one vehicle and one driver at a time. But the demand slammed us back. And there are still many clients calling multiple companies to get their needs
Correct.
met. So,
but then what happens? So Kim, what happened with all these companies that are debt heavy because they have so much demand that they have to increase their loans to get more equipment, and then would get hit with a recession, and we have a 20-30% reduction. What's the chances of those companies surviving if they're not capital?
Daniel, what you just described is a mathematical equation, and literally you have several variables there. Okay, when you know your cost structure and you manage it on a monthly basis, and you and I are able to go back to last March together and say, last March we did 500,000. This month we're doing 700, and we're able to project and forecast. You can pivot to look at what happens to your financial situation if you get a reduction in revenue. I want you to keep in mind something. The only thing you don't know about your financial statements, the only variable, is your revenue. You know everything else. If you're managing your financials, if you have done a financial review, you know that fuel is 9% of your total income. Okay. So if you do less income, this is what your fuel bill is going to be. So it's a mathematical equation. The answer I have for you is you have to be very careful when you put on debt. You have to be very careful of how it impacts moving forward. So if you did a budget and you said, I want to add 5 motor coaches to it, times 6,000 apiece, pretty damn close to the loan amount. What does it mean? That's $30,000 cash drag on the business, right? So it's a mathematical equation. So my answer to you is very simple. You've got no chance of survival if you're not budgeting and managing your financial statements. Okay? Now, I'm not going to mention any names, but we lost a pretty large operator within 60 days of the pandemic. And I knew him fairly well. He had so much debt and he had so much money out on the street, he couldn't survive. He owed so many affiliates that he literally just turned over the keys to his business to the largest local affiliate that he owed money to. So my answer to you is, you should be forecasting what happens if your business goes up by 10%, goes down by 10%, goes down by 20%. What changes are you going to make? What are you going to get rid of if something happens and your revenue drops substantially? And like the banker said to me, okay, Daniel, you got to pay your fuel bill. You got to pay for your vehicle insurance, right? You're going to have to get rid of G&A. So it's a mathematical equation that all starts with proper financial management and budgeting. It's not sexy, okay, but it's the reality. It's like a game of musical chairs, right? Everybody's having fun while the music is on and everybody is dancing. Okay, to me, that was the entire industry pre-pandemic. There was a lot of movement. No. There was a lot of movement. Everybody was happy. 2019, movement. Top line revenue, buying vehicles off the floor. The pandemic is when the music stopped. Now, here's a good reality. The people that survived should learn that lesson, right? They should learn the lesson, how difficult it was. Okay? So I think we can withstand 20% drop in revenue over a period as long as we can shed assets, God forbid, if something were to happen. You could shed vehicles, lower your long-term liabilities. But the reality is everybody should be managing their financials on a monthly basis, and they should be doing what I call a dynamic budget, which is don't be afraid to look at the end of the month and say, shit, we only did 8%. We did 8% less than we did last year. Why? Okay, well, last year you might have had 5 weekends instead of 4. Last year you might have had a big group. Do you have anything to worry about there, right? But the reality is if you're not looking at those numbers at the end of the month and all you're looking at is the top line revenue, that's not financial management. That's like a chef who celebrates every meal going out the kitchen, but doesn't pay attention to the cost of the ingredients, right? Keep going. I got 1,000 of them.
Yeah. So just for the sake of time, again, you drop a lot of nuggets, and I really thank you for sharing all this wisdom. What is your best book recommendation, and what is the best business advice you ever got in Canada?
So the best business advice I ever got was from Jack Welch, who was the chairman of GE. I put the security system in his house in Marblehead when I was a very young man. And Jack basically said to me, Ken, at the end of the day, every business needs a plan. I don't care whether you write it on a matchbook, you need goals and objectives, and you need to measure those goals and objectives. That was some of the best advice I could ever get. Ever got.
It could have gotten better than that.
So I will also share with you that someone very wise said to me that a businessman, a private business person is his brand. And when you're promoting your business, you are your brand. So you need to act accordingly as to what that brand stands for. That was good advice.
Thank you. What about the best business books?
Oh, Napoleon Hill, Think and Grow Rich. Built to Last. God forbid I forget his name, but Built to Last was another fantastic book. I forget his name. And then I'll tell you right now, our industry could benefit, and it changed my business career, was the Ritz-Carlton, the gold standard. Okay? Ritz-Carlton's gold standard. The best thing I did for my business when I was an operator, when I started this business, I went back and took my finance courses over again because I was a terrible accounting student. After I did the 2012 presidential conventions, it was $1.4 million in revenue in 14 days. It was the most stressful business thing I've ever did. My staff in Tampa said to me, if you don't go on vacation, we're all leaving. So I spent 30 days at the Ritz-Carlton in Pentagon City, taking all of the Ritz-Carlton leadership courses. And because I lived there for 30 days, I got to really see the behind the scenes. So the Ritz-Carlton Gold Standard is a book that talks about how the Ritz-Carlton brand became what it is. And to me, people in our industry need to understand something. It's not about getting from point A to point B. It's about what happens along the way. If you have a bus driver who's surly, or you have a chauffeur who's wearing tons of cologne, or you have someone who's blaring music, it takes away from the service experience. And the only way that we're going to survive as an industry is if we improve the level of service and get people start talking about the service experience of our companies. So those are the three. And I wouldn't put them in any order. Built to Last will teach you the fundamentals about how to build an organization that will, frankly, survive you. Because if you are the chief cook and bottle washer and things collapse when you're not there, that's not an enterprise with value. Congratulations. You basically you created a job. And I've done that many times, but I've not created an enterprise with value. My goal, and I'll leave you with this, my goal was always to be the least important person running the operation. Okay? Number one, because I didn't really particularly care for the small tiny operational details. I was focused primarily on what I wrote the book about, the client experiences. But my goal was to write all the processes and procedures down. And so that if you worked for me for 90 days and came to me every day, by the 91st day, you would know how I came down on a given decision.
I
have
100% agree.
Okay, because the people that have to control every aspect of everything in their business, they are the hamsters on the wheel.
Correct.
Okay, and you're going to notice that they also have a certain caliber of people working for them. They don't have people that are. You have to let your people make mistakes. You have to let them make mistakes, and you have to correct them. But shame on you if it happens 2 or 3 times, because you obviously didn't write down a process for them to follow, right? So
I 100% agree. And again, you dropped some really good nuggets. We should do a second episode because I feel you have so much to share. So with that being said, Ken, how can, for all the listeners, learn more about driving transactions, and how can they hear more about you?
So drivingtransactions.com is our website. There's a form online if you'd like to talk to us about business valuations. We have a financial management course coming out called Driving Your Profits. That'll be out later in the month. You'll probably hear about it on Chauffeur Driven. My email is klucci@drivingyouриncome.com. I never gave that up. That was my book. The book is going to come out in a second revision if my publisher ever decides to renew me. I was right on the threshold there before the pandemic, anyway. So, but check out the website. We do a lot more than on the website, but primarily the enterprise review, financial review and analysis. And I've never had anybody say they didn't get good value from it. I mean, we've really, when you drill down and you say to the operator, did you notice that you've gone up across the board on this, but you haven't gone up on this minibus category? Everything else is, why didn't you go up on your minibuses? Geez, Ken, we didn't really even look at that contract. Okay, well, it's time.
Yep.
The financial analysis piece is whether you want to grow your business and do a dynamic budget, or whether you want us to put a value on it to sell it. That's the starting point. But, we're pretty blessed with what we've got for data. I couldn't do this without the kid with the corporate finance degree. I think he likes to work for me because he doesn't have to cut his hair.
Sounds good.
Yeah.
So with that being said, again, for all the listeners, this is Kenneth Lucci with Driving Transactions. Please make sure you follow and subscribe on the next episode. And if you have a ground transportation program where we could help you with your solutions, please go into dpvtransportation.com. Again, if you're looking to buy or sell a business, please make sure you connect with Ken Lucci at driveintransactions.com. With that being said, thank you very much, Ken. Appreciate you.
Ken, it was an absolute pleasure. I want you to keep in touch. It would be my honor to come back anytime you think I can add value.
Perfect. Thank you very much, Ken.
Thanks for tuning in to the future of ground transportation. We appreciate you coming along for the ride. If you found value in this episode and want to hear more, please make sure to subscribe to the show.